TJX has bucked the trend the last 5 years and is one of a few large retailers that has been able to crush the returns of the S&P, returning roughly 150% over the last 5 years versus the S&P's returns of roughly 90%. To emphasize, this is a period in which the retail industry as a whole, characterized by the SPDR ETF XRT, has underperformed the S&P by nearly 20%. Department store giants like Kohl's, down 25%, or Target, down 36%. Discount giants like Dollar General, down 44% too. TJX has been able to overachieve and beat the S&P despite this environment due to the resistant and innovative adapted off-price business model. The record of outperformance makes this company interesting to determine if we will be adding to our portfolio. The 3 tenets of their business model are as below. First, they make shopping in store fun by having it be a treasure hunt experience in which every visit brings new, fresh merchandise. Second, they engage in opportunistic strategic sourcing, which enables them to pay less for merchandise from vendors that allow them to pass those savings on to their customers. Third, and this is related to the treasure hunt experience, but they buy low quantities of each product and expect it to be sold right away, rapid inventory turns. Now to dig into the first point, a treasure hunt experience, and this is an essential aspect for any large retailer this day and age to prevent it from being Amazoned. It is much easier and more convenient to be buying product online, which the growth of e-commerce definitely has a secular tailwind. To survive, retailers need the concept of shopping in stores to be due to enjoyment versus out of necessity. TJX stores have excelled at this with their constant rotation of brand name merchandise at deep discounts that make every visit unique. The excitement of finding a high-end brand at a low price is the core of their appeal. The second tenet is opportunistic buy-in. This is their moat. TJX has over 1,300 buyers who work with over 21,000 vendors that enable them to buy high-quality product at a very cheap price due to various reasons. Vendors may have had overruns or canceled orders and will offer the product to TJX for 20 to 60% off from what they sell to other retailers just to get the inventory off of their books. TJX has a flexible and nimble supply chain that enables them to take these smaller one-time runs versus other retailers like Target cannot, due to Target's brand is the everything store, so product consistency and availability is the most important factor for Target. The third tenet is rapid inventory movement. This is important to keep the treasure hunt appeal, but most importantly, it allows them to have maximum flexibility in their business model to quickly react to the hottest trends in the marketplace and changing customer preferences. TJX has a world-class supply chain, and quick inventory turns allows them to leverage it to maximize the amount of time they can get the right product at the right store at the right time. So I think we've established that TJX has thrived due to their state-of-the-art supply chain and the strength of their business model. Now let's better understand what TJX actually does. They are among the top 100 largest companies in the United States by revenue and have 6 different store brands: TJ Maxx, Marshalls, Home Goods, HomeSense, Winners, and Sierra. These stores operate in the United States, Canada, Europe, and Australia, and the majority of their sales come from TJ Maxx and Marshalls, which is their apparel assortment stores in the United States. Now, they also do have other store brands that sell home furnishings. From a growth perspective, they are limited, as new store openings are going to be minimal relative to the size that they already are. They currently have roughly 5,100 stores and believe that there's a maximum of 7,000 stores that can be supported. In the last quarter, they've only built 13 new stores. So really, same store sale growth is going to be the key metric to keep an eye on for TJX. From a financials perspective, TJX is quite predictable. Their trailing 12-month revenue is $56 billion, and their second quarter update reflected a 7% revenue growth year over year. Typically, the revenue growth is between 4 to 8%, which is nice to be this stable even during recessionary periods, since as a low-cost provider, they can become even more popular of an option when people need to spread their paychecks further on small luxuries. Net income was as predicted around 11%, which had minimal tariff impact, a testament to their supply chain sourcing advantage and being able to buy product from the 21,000 vendors in over 100 countries. Overall, financials are nice and stable. Even though I typically like companies with greater than 20% revenue growth, this might be a good add as an anchor to hedge against sell-offs in the tech names while still having a chance to outperform the S&P. For three watchouts, I would have to keep an eye on for TJX. First, I would want to keep an eye on the intensified competition from online retailers. I'm not worried about Nordstrom opening more Nordstrom racks, discount stores, as TJX's value proposition is being able to bring merchandise from a variety of sources. In particular, I am mostly concerned about the growth of TikTok's flash sales model in China, in which an influencer would model merchandise during a live stream and sales can be made immediately. So far, this model has not become a trend in the countries TJX operates in, but if it does, it can copy TJX's business model at an even cheaper cost. Second watch out I'd want to keep an eye on is the cost of inventory they have on hand at the end of each quarter. Don't want to see a constant increase on this, as this means the merchandise they bought is not rapidly selling, so cracks are showing in their opportunistic buy-in data, and their future profit margins may take a hit. Third watch out is valuation, which we will detail more into next, but this is not a high-growth company, so valuation will be critical to buy an entry point that supports the fundamentals growth. Now, before we get into valuation, please read the disclaimer in the notes below. We are not financial advisors, nor anything we say should be taken as formal advice or a formal recommendation. Also, if you enjoy deep dives like this on long-term, innovative-focused companies, please help us out and click subscribe as we aim to release weekly episodes. Looking at where TJX sits on the business lifecycle chart, and I would put them here as mature. They are a stable business able to generate 4 to 8% annual revenue growth, but currently has stores in 5,000 of their long-term target 7,000 store locations. Over 70% of possible locations have already been built. On the earnings release too, TJX prides itself on sharing how much cash they return to shareholders with an ever-increasing dividend and also share buybacks. With them being a mature company, the metric I would evaluate them on is PE ratio. And with their earnings and revenue growth stable and resilient despite economic conditions, I will model out their share price 5 years out from now in 2030. So their revenue typically grows year over year between 4 to 8%, mostly driven by increases in same-store sales. Let's take the high end of that and assume an 8% CAGR for the next 5 years. Earnings, net income, will then grow only a bit higher at, say, 10%. Slight operating leverage can be gained with their minimal new store count openings, so it grows a little higher than revenue growth. However, it won't grow much more as gross margins are already around 30%. So it'll be tough for them to keep increasing that while keeping their value proposition for customers as a low price retailer. From a PE ratio, we'll use a 25, which is generous, as assumes a 2.5 PEG ratio, but is also lower than TJX's current PE ratio of around 30. Based on these assumptions, it has TJX at a $197 billion market cap by 2030, or $176 a share. This is about 25% higher than their share price today, September 8th. Now, this is a bit subjective, and returns model could be higher if we assume a higher PE ratio than 25. But the reason I assume this is the retail leader, Costco, has been trading at this 20 to 25 PE ratio up until 2019. And as Costco is the gold standard for retailer, in my opinion, I feel this is a fair valuation based on fundamentals. Reminder, this is a company that grows revenue at 10% a year with a PEG ratio modeled at 2.5. So it does give a premium for TJX based on its resilient off-price business model. Now, let's run TJX through my 5-point framework. From a leadership perspective, TJX's CEO, Ernie Herrmann, has been CEO since 2016, but has worked at the company since 1989. This long career at TJX is a plus for me, as he really understands the company culture and has been with them through various recession and growth cycles. However, TJX gets a neutral for this, as their strategy, which even though successful, will remain the same. I suppose if it's not broken, why fix it? But I like my company's culture to be one like Nubank's, in which there's a paranoid desire to keep innovating to get better while also maintaining their base. From a valuation, I have TJX as a very weak. With our valuation model, we assume it only grows at a 25% increase over the next 5 years. 5% returns annually is unlikely to beat the S&P. From a revenue and profit growth perspective, the numbers of 8% revenue growth and 10% earnings growth is weak. However, I have this rated as a neutral since it is resilient and can be one of the very few businesses that continues to grow should we enter an economic recession. From a total addressable market, I have this as a neutral. TJX operates only in Europe, North America, and Australia and sells mostly apparel and home furnishings, so it's a bit niche. However, value-conscious consumers is a broad customer base, so that's why this overall gets a neutral. From a secular tailwind perspective, I have this as a weak, since physical storefronts will continue to be in decline, with the main growth tailwind being the growth of e-commerce. TJX, though, is able to maintain low costs, and their treasure hunt experience makes them a fun experience beyond just buying necessities, which has set TJX apart from other physical storefront retailers. Overall, TJX did not score well on my framework for long-term innovative companies. However, like Berkshire Hathaway, this might be a company we buy at the right valuation since its value fundamentals look like they can support a 10+% annual earnings growth. So, if the stock is back around a $95 per share price, the risk-reward model for me makes sense to add as strictly a value play with confidence that at that price it has a chance to outperform the S&P 500. What are your thoughts, Dad?
Yes, thank you, Scott, for that wonderful analysis. Yes, I like to go over my criteria now. Okay, for company fundamentals, the dividend is, I have 1.2% for TJX. The beta is 0.9, and the earnings comes out on November 19th. So putting all that together, I have a neutral to positive. Okay, the earnings history of the last 4 earnings, they beat each time. So they're 404 for the last 4 earnings. They beat 4 times out of 4, so that's a positive. The net profit margin is 11%, so I have that as a neutral. The debt to equity is around 34%, which is neutral to positive. As we look at the PEG ratio, I have 2.5, and that's a neutral. And then I look at the Bollinger Bands. It's just between the middle and upper band, and it's a little wider than usual, so it's a little bit more volatile. So I consider that to be neutral to positive. And then looking at the moving average, as you can see, the 50 is above the 200-day, and the 200-day slope is positive, and the price is above both the 50 and 200 days. So that's most definitely a positive. And then I look at the RSI, and the RSI is at 69.4%. And if it's at 70%, it's considered overbought. And it seems like for the last few weeks, it's bumped against that 70% mark, and then it's went down a little bit. So I'm a neutral to negative on that one. And then looking at the analysts that I follow, there's 1 strong sell, 2 sells, 10 buys. So that's I consider that to be neutral to positive. And overall, TGX is a good company, but like what Scott was saying about the store count, I'm a little concerned about that they may be getting to the point where they're almost saturated. In the U.S., I know they could do international, which is a possibility, but being with that and being with the macro, the whole market is just priced so high right now. I would put it on a watch list and maybe wait for it to go down a little bit because of the RSI being bumping up against the 70% and just the other factors, mostly the macro of the market. And it also has 1 strong sell and 2 sells. So my take is for just to keep it on the watch list. So Scott, so back to you.
Thanks, Dad. And I agree. TJX is a phenomenal company, and we will add it to our watch list because it's just not a good valuation. To get a fair, risk-adjusted reward, we will look to buy around $95, which I know that seems like a lot from here, but it was that price back in May 2024. Nevertheless, thank you for watching. To help us out, please like, comment, or subscribe as we aim to release weekly, regular deep dives about innovative, long-term focused companies. Until next time, happy investing.